They tried to shake you out. That's the truth. What you saw yesterday was not an accident. It was not random. And it was definitely not the end of the bull run. It was a trap, and most people walked straight into it. If you watched the market over the last 24 hours, you felt it. Your screen was red. Silver was crashing. Headlines were screaming. Social media was panicking. You probably felt that tight feeling in your chest. You probably thought, what if this is it? You probably hovered over the sell button just to make the pain stop. That reaction is human, and that reaction is exactly what the market was counting on. But now stop, take a breath, and look at what just happened today. Silver is back above 70 for dollars. In a single session, it erased a massive part of the crash. Billions of dollars rushed back in. Ask yourself one simple question. If this move was real weakness, why did the price snap back so fast? Real crashes don't bounce like this. Here's the hard truth most people don't want to hear. Yesterday was not a correction. It was not a breakdown. It was a forced sell-off, designed to scare weak hands out of their positions. This is how modern markets work. The big players don't buy when prices are calm. They buy when fear is high. They buy when people panic. They buy when you feel sick to your stomach. Let's talk about why the drop happened. Retail traders were crowded. Stops were sitting in obvious places. Leverage was high. The market knew exactly where those stop losses were, so the price was pushed down. Those stops were hit. Positions were liquidated. And silver was dumped at fire sale prices. Not because fundamentals changed, not because demand vanished, but because fear creates sellers. And sellers create opportunity. This is the part most people miss. At $80, nobody was selling. Strong hands were holding tight. Physical buyers were waiting. So the market had to create sellers. It had to shake the tree. Yesterday was the shake. Today is the beginning of the harvest. Now listen carefully, because this matters. Nothing fundamental broke. The mines didn't shut down. Factories didn't stop using silver. The dollar didn't magically become strong money overnight. The only thing that changed was sentiment. Fear replaced confidence. And then, once the fear was exhausted, price snapped back. That is not bearish behavior. That is classic bull market behavior. This is what bull markets do. They punish impatience. They reward discipline. They test you when you least expect it. And yesterday was a test. The question is not what happened to the price. The real question is, did the move shake you, or did you survive it? Because here's the key idea you need to understand going forward. If they needed fear to push the price down, it means the natural direction is still up. If the market has to force selling, it means real supply is tight. And if supply is tight, the next move higher can be violent. In the next part, we are going to break down who was actually buying during the crash, why the bounce was so aggressive, and why this move may have confirmed the bull market instead of ending it. Because if you think yesterday was chaos, wait until you see what comes next. Now let's talk about the most important question. Who was buying, while everyone else was panicking? Because make no mistake, yesterday's selling did not disappear into thin air. Someone was on the other side of those trades, and it wasn't emotional retail traders. When the price was falling fast, two groups stepped in. First, institutions, big funds, pension money. Players who think in quarters and years, not minutes. Second, physical buyers, industrial users. People who actually need silver to run factories, make electronics, and build batteries. These buyers do not chase price, they wait for fear. And yesterday gave them exactly what they wanted. Let's talk about the physical market for a moment. While the paper price was crashing, something strange was happening. Bullion dealers did not lower premiums. In many cases, they raised them. That tells you everything. If silver was truly weak, premiums would collapse. But they didn't. Physical silver was being pulled off the market, not dumped. That means real demand was absorbing the selling. This is how you know the bottom was forming. The paper market tried to push the price lower. But the physical market said no. Buyers stepped in at $73. They stepped in at $72. Some didn't even wait for the low. They were happy to take whatever sellers gave them. That creates a floor. And once sellers run out, price has only one direction left. Now let's talk about the machines. Modern markets are not run by humans. They are run by algorithms. Momentum-based systems called CTAs. These systems do one thing. They chase price. When silver fell through key levels, the algorithms flipped to sell. They dumped futures, they added fuel to the fire. That's why the move felt so violent. But here's the part most people don't understand. Algorithms don't think, they react, and when price stopped falling, they had to flip again. As silver reclaimed $73, then $74, the machines were forced to buy back everything they sold. Not slowly, all at once. This is called a forced reversal. They covered shorts and opened new long positions at the same time. That's why the bounce was fast. That's why it felt explosive. This is why you saw a vertical green candle. It wasn't hope. It wasn't luck. It was trapped sellers being forced to buy. And when that happens, price doesn't climb, it jumps. Now let's bring gold into the picture. Yesterday, gold fell hard. It scared people. It felt like something was breaking. But today, gold stabilized and bounced. That tells us the liquidity stress passed. The bond market calmed down. The panic faded. And once gold found its footing, silver was given the green light. Remember this rule: gold is the anchor, silver is the accelerator. When gold stabilizes, silver moves faster. Today proved that relationship is alive and well. Gold rose modestly, silver surged. That is bull market behavior. This move also tells us something deeper. If silver were truly in trouble, it would not lead the recovery. Weak assets lag. Strong assets bounce first. Silver didn't just recover, it outperformed. That confirmed strength under the surface. Now think about what just happened emotionally. Yesterday, fear was everywhere. People were questioning the trade. Some sold at the worst possible moment. Today, those same people are watching price climb without them. That pain is real, and pain creates the next wave of buyers. This is how bull markets climb. They don't go straight up. They move in waves of fear and relief. They shake people out, then leave them behind. And the market does not wait for permission to move higher. In the next and final part, we are going to talk about what happens next, why the final trading days matter so much, why big money has a reason to push prices higher, and how you should think about positioning going forward. Because this story is not over, in many ways, it's just getting started. Now let's talk about what happens next, because this is where most people get it wrong. They survive the drop. They enjoy the bounce. And then they make a mistake, not because they were wrong about the market, but because they misunderstand timing and incentives. We are heading into the final trading days of the year. And this matters more than most people realize. Big funds are judged on where prices close, not where they traded. Bonuses are decided at the closing bell. Performance reports are locked in at year-end. That creates pressure. If funds are long silver, they want the price as high as possible when the year closes. That means buying support. That means defending pullbacks. That means strength into the close. This is called marking the close, and it happens every year. What you saw today was likely the beginning of that process. The damage from the crash is being erased. The chart is being repaired. Weakness is being removed from the record. This is not random. Money has a reason to act now. Let's look at the chart for a moment. Yesterday, silver broke below short-term support. That scared people, but today, it reclaimed that level immediately. In trading, speed matters. When a breakdown fails quickly, it is not bearish. It is bullish. It means sellers tried and failed. That failure traps shorts, and trapped shorts become buyers. Now ask yourself this: if the price dips tomorrow, who is selling? Weak hands already sold yesterday. Physical buyers are waiting below. Short sellers are nervous. That creates a safety net. If price rises, momentum buyers chase. If price falls, shorts cover. That is how you get asymmetric upside. Now let's talk psychology. Yesterday felt awful. Today feels better. But relief can be dangerous. Relief makes people relax. And this market does not reward complacency. Volatility is not gone. Order books are still thin. Liquidity is still fragile. We could see sharp moves up or down very quickly. But volatility does not mean weakness. In fact, in bull markets, volatility is the price of admission. Here is the mindset you need going forward. Do not focus on dollars. Focus on ounces. Yesterday, did your ounces disappear? No. Today, did they magically increase? No. The metal did not change. Only the price did. And price is noise in the short term. This is also where the bigger picture matters. We are moving into a new year. Budgets reset. New money enters, industrial demand returns. At the same time, supply remains tight. That combination is powerful. Fresh demand, limited supply. That is not a recipe for lower prices. So what is the strategy? Simple. Do not overtrade. Do not panic. Do not try to outsmart every candle. If price dips, that is not a threat, it is information. It tells you demand is waiting below. As long as the larger trend holds, the path forward remains intact. Yesterday was not a failure. It was a test of patience, a test of conviction, a test of position size. Some people failed that test, others passed, and the market has already started rewarding those who stayed calm. This is how bull markets separate participants. Not by intelligence, not by predictions, but by emotional control. So remember this moment, remember how fear felt, remember how fast it changed, and remember that the market will try this again. Next time, the move may be bigger, faster, more violent, but now you've seen the pattern. The trap failed, the recovery began, and the bigger trend remains alive. Stay patient, stay disciplined, and stay focused on the long game. Because the story isn't over, it's only entering the next chapter.